Hello, I'm Kevin French from Core Wealth. We're going to have a look at what happened in the month of September 2025, as well as the quarter and year to date. The month of September started really positively. We saw markets up around the world. The US was up over 3% for the month and up over 7% for the third quarter of 2025. This is on the back of the Federal Reserve in the US reducing interest rates for the first time in a year now. We saw a lot of the technology stocks really performing strongly on the back of this, but the market as a whole was still quite concentrated around those technology stocks, and we still saw some of the more consumer-facing stocks and the healthcare stocks lagging for the month. One of the other strong drivers of the market returns for the month was the whole artificial intelligence theme. And we saw news of OpenAI and NVIDIA's discussions together really sparking that. The emerging markets, however, were a lot stronger than developed markets and have been so far this year. I'll show you the figures later on. This has seen the emerging markets outperforming developed markets by about 10% so far year to date. Markets like China, like Taiwan were some of the main drivers of this outperformance. September was a really strong month in South Africa and driven particularly by the precious metals miners. We saw that September was the strongest month so far this year, and also on a quarterly basis, it was the strongest quarter that the JSE has seen in the last 5 years. If we look at the market, the JSE equity market just for this year up 31% so far. So some really strong drivers behind the South African equity market. September was a month where we saw some big negative macro things happening. For example, in the US, the shutdown of the US government because of deadlocks in terms of negotiations between the Democrats and the Republicans. And in South Africa, we've seen consumer sentiment and business sentiment coming out a bit softer than expected. And despite that, we've seen markets really pushing ahead strongly because of essentially lower interest rates globally. So having a look at that monthly column of September, we can see that it was all green. And that's just, again, evidence of how strong markets have been over this last little while. If we have a look at the year-to-date figures, probably the standout comment there is that emerging markets have outperformed the developed markets by more than 10% over the last 9 months. If we start looking at some of the other standout numbers over 3 years, we can see that the European equity markets actually outperformed the US. UK equity markets actually not that far behind the US equity markets. So some interesting turnaround. We've had a long period of time where US exceptionalism has driven that market, and it has been the main driver of global markets. But as we've said before, we think some of that is starting to change. As mentioned earlier, the South African market also had a really good September and the last quarter as well. And so if you have a look on this slide, we can see our equity markets up over 6.5% for the month, and our bond market's also doing well, up 3.3% for the month, and year to date the bond market's up 14%. If we have a look at equity markets, they're getting close to 32% for the year-to-date figure. And then if we start looking back over longer periods of time, we can see over 5 years, the South African equity market up over 19%, while inflation was at 5%. So some significant real returns, and that is really what's been driving a lot of the wealth growth that we've seen in clients' portfolios. Interesting to have a look at the currencies. The red on the US dollar versus the rand, and similarly for pounds and euros, is really meaning that the rand has been strengthening. We know currencies can be volatile, but you have a look over the longer term, over the last 5 years and even over the last 10 years, the actual depreciation of the rand over the last 5 years against the dollar, 0.7% a year. Over the last 10 years against the dollar, just 2.3%. Against the pound, just 1.1%. So if we have a look over the longer periods of time, we can see that the rand has actually held its own quite well, between 0.7 and 1.7% depreciation against the dollar and the pound over the last 5 years, and over the last 10 years between 1 and 2.5%, 3% against those major currencies over the 10-year period. So the demand for precious metals has been a driver of that, as well as the lower inflation that we've managed to maintain in South Africa. So as you'd expect, the absolute return of our strategies has been strong because the underlying markets have been strong. But what's as important to us is how have we done relative to our peers. And the good news is that we've seen some really good outperformance of our peers, so adding some good what we call alpha to clients' portfolios. This is a table of our global strategies, but those that we look at the world through a UK sterling lens, and we can see over the last year some outperformance of between 1.8 and 2.3% over the different models over the last year, and over the longer term still outperforming since inception, although it's relatively short period of time, heading towards 4 years now. So if we have a look at the same, but our models that look at the world through a US dollar lens, we can see here over the last year some really strong outperformance as well as absolute returns, almost 15% on our growth model. If we have a look through time as well, we see some consistent levels of outperformance relative to the peer groups or the class averages. Our since inception number now heading towards a 9-year track record, and some 8.7% on our growth strategy, which is 1.7% ahead of peers. So very satisfying results there. So here we have our Rand denominated or South African models, and we can see here a really good last year, some strong outperformance of the peer groups again, and this has been driven by exposure to equities and our equity managers doing particularly well as some good results on the fixed income side. But probably what's really exciting to see now is that the since inception returns, some of them have moved into double-digit numbers. We had always had the lag of the Zuma years where markets were so soft. While we've continued to maintain outperformance, those numbers were struggling to get into the double-digit levels. And so we can see our two most aggressive strategies, retirement growth and flexible, now both of them into double digits with some healthy outperformance of the competition as well. Artificial intelligence. It's not a new subject, it's something that's been around for many, many years. And it's something of late that's the last couple of years has been very high on the agenda at different global investment conferences. And what we're going to unpack today is just how that's going to impact things and what has the growth been so far. So if one looks back at technologies through time, it's important to have a look at how quickly that technology gets adopted. And this graph, courtesy of one of our investment managers, Peregrine, just shows you how quickly artificial intelligence has been adopted. It's the yellowy colored line in this graph, and compared to things like the internet, the mobile phone, personal computers, cars and electricity. To give you an idea of the numbers, between December 2024 and February 2025, the users of ChatGPT increased by a third, from 300 million to 400 million. But by October, that number had doubled again. It was at 800 million people or users around the world. So some significant growth. In the US, adoption rates of artificial intelligence are getting close to 10% and could actually exceed that by the end of this year. Why that's so important is that if you look through time at different industries, once they reach that magical 10%, it gets to a point of being used on a wholesale basis through the economy. To give you an idea, we are close to that, as I said earlier, but things like the mobile phone or smartphones and e-commerce took between 5 and 25 years to get to that same 10% adoption rate. So strong tailwinds for adoption of AI into the economies. Our thinking on the impact of artificial intelligence is how it's going to drive productivity. And the graph that we have here on the left-hand side just shows the US labor productivity growth going back to the late 1800s. And we can see that actually over the last little while, until 2022, US productivity had come down after the housing bubble in the GFC or the global financial crisis, and then had been moving sideways. But subsequently, we've seen it tick up quite strongly over the last couple of years. And this is on the back of more and more productivity gains being achieved through artificial intelligence. Then the graph on the right just shows you the different industries that are adopting the use of artificial intelligence. And while information technology is at the top of that, we can see that in a number of other industries, the adoption rates are actually very, very high. So this points to a future where we could see productivity improving quite significantly across the industry, not just in tech. So where can we get the most bang for our investment buck? And one of those areas is in the infrastructure space. So data centers are going to be needed to bring all of this information together. And here you can see the spend that has been made on construction of data centers. And really we can see since 2022 really picked up strongly, and that is expected to continue into the future. Morgan Stanley is actually estimating that around $3 trillion will be invested into AI-focused infrastructure over the coming years. Processing power is needed to process the data that is housed in all of these data centers, and from which these large language models need to learn things. This graph just has a look at the semiconductor sales worldwide. We can see that initially you might think, well, it's going up, but it's not going up as steep as the previous graph. But when you have a look at the scale, because this is a logarithmic scale, the growth over the last 5 years has been more than 50%. So some significant spend that's going into buying these processors or these semiconductors, and that is something that is expected. So as demand continues to grow, because more people are using large language models and artificial intelligence, there will be an increased demand and an underpin for sales of semiconductors globally. So if we look at some of these technology companies that are going to benefit or be involved in artificial intelligence rollout, we can see that they aren't cheap at the moment. So if we have a look at this graph, the green line shows the price earnings ratio of companies in that system software index on the S&P 500, basically your tech companies. And we can see that they're at the upper end of their range that they've been historically. So they're not cheap at the moment. However, if we have a look at the earnings that are projected on these companies over the coming years, all around 15% over the next 2 years, and that is really what's driving the demand. People saying, well, at the moment they're projecting those earnings, but if things end up on the positive side of some of the points we made earlier, that could be even higher. However, one has to carry the risk at the same time that if earnings are missed and things don't turn out as well, that we could see quite a good correction or severe correction on some of those expensive companies. So what we've done in this slide is just look at our global strategies and had a look at what exposure they have to companies that are involved in AI. The initial 2 columns, just have a look at those that are involved in more in the software space, and the second column is those that are more involved in the infrastructure space, so things like data warehouses. And then the total AI column is just saying those 2 added together. So somebody like 91's global franchise at the top of that list has just over 25% exposure to companies that are involved in AI, and you can run your eye down there, you'll maybe recognize some of those names. Another quite well-known one is Orbis, who are more of a valuation-driven manager, so are less inclined to pay up. If a company is expensive, they'd rather steer clear of it and maybe only invest as prices come down. But even an investor like Orbis has over 12.5% exposure to AI. So it is a theme for the future. It is a theme where there are some really good companies globally, but there are some cautions around valuations, and managers are being sensitive to that. So hopefully that's given you a little bit more insight through the noise around artificial intelligence, because as with all topics that get a lot of headlines, sometimes it just seems so noisy, but it really is an opportunity to improve productivity globally, and that could have a good impact on the returns that one can have in a portfolio through the longer term. If you have any questions, please get hold of us or your financial advisor, or post them in the comments below, and we'd love to get back to you on that. If you have topics that you'd like us to cover, please add them to the comments so we can see that, and we'll try and add them into future wrap-ups. Please share this video with your friends and family. We'd love more and more people to learn more about the markets. Thanks very much for watching. We'll see you soon.